Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
Iran, I guess, starts on Exhibit C. The ceasefire, if it holds, I think the production numbers, Exhibit C for 26 will turn out to be Arabia will be down, U.S. will be up, Russia will be up, the other Gulf Arabs will be down. But I think the result will be a decline in production from 103 to maybe 1 million barrels a day less. I don't think the decline will be more than that, but we will see as each week goes by. In terms of consumption, the price is going to be much higher no matter what happens. I don't think demand was slowing down because China is absolutely flat. Demand will be level with last year at the 103 level. I don't think it will decline too much. When we turn to Exhibit B, the futures price, which is always the futures price from last Thursday, the prompt price was 108. The price when you got out to 27 was 70. Prompt price, if the ceasefire holds, will move down into the 90s. I think the 27 price at 70 will be maintained. I think average price for the remainder of 26, say May through December of 26, will be somewhere in the $80 range. The higher the oil price, the lower the gas price is, because of the growth in Permian production, which is associated gas. So Permian production, 2/3 of the increase in gas production, dry gas production. And so higher oil prices, there'll be more activity in the Permian Basin and there'll be more gas. And towards that end, the Waha hub out there, which is where gas settles, has been in negative territory since the beginning of the year. And there's more pipe capacity being built, and eventually it'll come from negative territory. But out of our total dry gas production for last year, for 25 of 106, Permian was about 23. I think it'll easily be 25 this year and 27 the year following. As that gas reaches the Gulf Coast or wherever it's going to be consumed, I think it'll start to impact the price of natural gas measured by Henry Hub pricing. So last Thursday, the Henry Hub price was $2.86. The 27 price was $3.70. So there's a little bit of contango there. We have an estimated gas price for 26 at $3.80. I hope that holds. When we got an oversupply, it's remarkable that last time we had a macro event was in 22. Henry Hub gas averaged $6. Now, granted, there was a big increase in demand for U.S. LNG. It just seems inexplicable with the benefit of hindsight. Our U.S. gas price got so high. The high gas price caused more production. Look at what happened. We did 95 million a day dry gas in 22 and 102 in 23. So the high price called for supply. And then the 23 average price was 275. And then it got all the way down to 240 and 24. So I think gas producers would be much better off if we didn't have that kind of volatility. And I'm hoping gas holds in the kind of $3.54 range. But if there's a problem, it's the impact of higher oil prices on production in the Delaware. And of course, 89% of Delaware is produced in association with oil. Exhibit A, macro. The president and his defense secretary and chairman of the Joint Chiefs were going to come to Congress and ask for $200 billion supplemental to this fiscal year for the war. The rumor now is they're going to just ask for 80. 80 is a lot of money, but it seems like a lot less than 200. The president is saying, or his budget director did send a budget proposal that included $1.5 trillion for defense. And you can see, look at Exhibit A, defense has been running around 900 billion. The 80 billion would increase it somewhat. I don't expect there's going to be anything like $1.5 trillion spent in fiscal 27 by the time Congress goes through its budget processing. Are we underspending on defense? We tell the NATO countries they need to spend 5% of their GNP. Our GNP is $31, $32 trillion. 5% would be $1.5 trillion. When we spend $1 trillion, that's only 3%. But of course, the European countries are spending under 2% now. When they say they're going to spend 5%, that is aspirational. So important priority for our capital markets to have this deficit continue to come down. Donald J. Trump keeps talking about tariffs, but if you look at revenue, our revenue for the fiscal year will be about $5.5 trillion, and only about $0.5 trillion will come from tariffs. And that's everything in the excise categories. Tariffs are probably only 300 out of that 500. 2.7 comes from us on the phone, individual income tax, payroll tax, which is Social Security and Medicare and whatnot. That's $1.8 trillion. And then corporate income tax is only $0.5 trillion. That's amazing how many holes there are in the tax code for corporations for R&D credits and accelerated depreciation and whatnot. So that's pretty steady on that $0.5 trillion range. That doesn't vary too much. Our increased revenues come from GNP growth that impacts individual income taxes, payroll taxes, and that can be expected to go up by about 300 billion, 350 billion a year. So in order to get the deficit, which is just under 2 trillion down, we need to get healthcare costs to flatten out. Can't do too much about Social Security, that's wired, but Medicare, Medicaid, if we can get that to flatten out. And I think this administration is making some progress there. Then that all other number needs to flatten out or go down, and that'll create a little bit of room for additional defense spending. And of course, interest, because we've run these deficits for so long. Look at the deficits we ran during COVID, 3 trillion in 20 and 3 trillion again in 21. And then in bounce back year, it was still $1.4 trillion, and then $1.7 trillion in 23. I mean, $1.9 trillion last in 24. I mean, it's just totally irresponsible. We cannot do this. What we need to do is have it decline, the deficit decline as a percentage of GNP, and have our debt not be more than about 100% of GNP. Absolutely have to do that. There is no other way out. Now I'm going to turn to Jason. Over to you, Jason.
No, I completely agree. And as far as the defense budget, I think modern battlefield is allowing us to cut costs. A lot of the discussion is about how expensive our missile interceptors are, but we also fielded a lot of really low budget versions of that are autonomous based and drone based, and those are just starting to become used by our military. So I think we'll be able to cut a lot of costs going forward and not relying on a $10 million missile to intercept a $20,000 drone in the future.
Right. And what it'll shift to is an age-old issue when it comes to war, that supply chain is really what's most important. It's one thing to have a stockpile, but it's another thing to have the productive capacity to be able to withstand a long-term engagement. The future of defense procurement will have more of a focus on productive capacity than on building stockpiles.
And speaking of supply chain, we look at the war in Iran and the war in Ukraine as kind of two independent fronts, but Iran's a supplier of a lot of the drone technology to the Russians to fight their war, and we just have removed that supply chain from them.
Good. We're going to try to follow up last Wednesday and focus on companies that have gotten large. Everyone's made a lot of money, but they have gotten into a position that is extremely difficult for small companies or large companies to compete with them. I think we touched on Lilly last week, and I think we have to go back to Lilly this week during our healthcare. But rather than talk about page one or page two, the software companies, I thought today it would be good to talk about the position NVIDIA has developed. Now, NVIDIA, if you're fortunate enough to have recognized it when it was just doing GPUs for gamers, has become a hugely more capable and competent company doing a lot more than just designing GPU chips. And with that as an introduction, Mike and Jason are going to take it from here in terms of explaining the colossus that NVIDIA has become. So over to Mike and Jason.
Okay, so what I want to talk about then is what are the things that makes NVIDIA special? We had written a paper previously about the software moat they have, the software that you use to control a GPU. It's known as CUDA, and NVIDIA has continued to expand that. But there's another dynamic that's at play here. So let me start by explaining that there's a book called The Seven Powers by a guy named Hamilton Helmer. He identifies these seven powers as things that enable companies to earn outsized profits over long periods of time. And looking backwards, it's obviously easier than looking forwards, but we look at NVIDIA backwards and we see that CUDA as a software package created a network effect that basically everybody that was programming GPUs was using CUDA, and therefore it was much easier to hire people and get projects up and going because everybody was on the same language. Now, we're going to write about this in our next quarterly letter. So this is a little bit of a preview in that NVIDIA's core competency is not necessarily this network effect. It actually goes back to 1997 when NVIDIA was on the brink of bankruptcy. They had 1 month of payroll remaining, and what Jensen was able to do is by acquiring a particular piece of machinery called a hardware emulator, it enabled them to accelerate their development timeline down to 9 months rather than what was a 2-year cadence that pretty much the rest of the industry was on. So that was a early bet the company situation that moved them into this process power competency. And the whole gist of process power is that a company that has the ability to iterate and move forward faster than its competitors develops a compounding moat. Now, it's best when that process power is developed over a period of time when no one else is looking, which is essentially what happened with NVIDIA. So post ImageNet 2012, between then and call it ChatGPT, so about 10 years, nobody was really paying attention to programming GPUs, certainly not at the level that NVIDIA was. And what evolved over that period of time was the NVIDIA data center hardware infrastructure. So they evolved from producing gaming chips to producing equipment for data centers. It started with the DGX-1 platform in 2017, which was essentially a gaming GPU equipped for a data center. And it utilized an Intel Xenon CPU, and it utilized Mellanox DPUs, data processing units, and NICs. And they had the NVIDIA networking. It was an early version of NVLink. Where it's gone from there to today is now the latest versions have not only NVIDIA GPUs, but NVIDIA CPUs that are specially designed to optimize the performance of the GPU. They've acquired Mellanox. That was back in 2019, I believe. They they now have the best networking on the market. And most recently, they've acquired Grok Q, a hardware company that makes what are known as LPUs. So without going into the details on all of those, the point is that the company is iterating faster and wider than anybody else in the industry. That being said, flip over to page 4. The company's doing over $100 billion in free cash flow a year, and likely this coming year will be significantly higher, meaning as a result, you have a very large target on your back. You have Google, which has not only the resources, but also the incentive to figure out how to get this right. And on some analysis, they've come out and shown that it can be cheaper to own and use TPUs for certain use cases. But so NVIDIA's position is basically dependent on them continuing to develop out this hardware in a way so that competitive solutions, even if they are cheaper, are not cheaper on a total cost of ownership basis.
Intel used to be our largest chip company. Look at page 4, they're sitting there at 50 billion of sales. They have no free cash flow. Advanced Micro gave Intel was the fits. They're at 35 billion of sales, 6 billion of free cash flow. Sure, NVIDIA has a target on its back, but how in the world, if you're the fellow at Intel trying to rescue Intel, or the lady at Advanced Micro, who's done a fantastic job, how in the world do you cope with competing with NVIDIA when NVIDIA is working its way into probably being, I don't know, Mike and Jason, 70 or 80% of all the equipment that goes into a data center? It's just how to compete with that is for the NVIDIA competitor, it's just such an incredible challenge. Or Jason, do you think that this is where Intel was at one point and the same thing might happen to NVIDIA?
In a way, I think NVIDIA is further along than Intel was because they still relied on third-party integrators to take their chips and build them into servers, put them into racks, ultimately end up with a data center. And NVIDIA has vertically integrated all of that. So they essentially sell you a data center. And that's why I think they can capture the margin that they do, because Intel had their margin on the chips. They supplied the chips to a Broadcom or Dell or someone, and Broadcom might have supplied the networking equipment. Dell assembled them all. So they're stacking the margin on top of each other. NVIDIA is just selling you a fully functional, a rack, a full aisle of equipment for your data center. And you just determine how many aisles of equipment that you want.
But I would say the original definition of process power was Intel and Moore's Law. And they actually voluntarily gave up on it because they feared that the economics of the next generation would not be good enough to satisfy their shareholders. And this is one of those things that, like, Andy Grove is turning in his grave, and Gordon Moore, all these guys who built this company around this, is they gave up their golden goose voluntarily. And I think as long as Jensen's around, NVIDIA won't let that happen.
And CPUs have hit the wall of Moore's Law, but computing hasn't, obviously. It's because we have these more specialized processors, that TPUs and GPUs, that we're calling it accelerated computing, but it's just the continuation with a different technology.
Yeah.
And I think NVIDIA's process power has not ended here. And I think they're still innovating in silence. The latest one we've seen is, I believe they're called Jetsons, but the robotics chips that they've been building. And that line of chips goes back probably a decade also, but they're just now starting to get talked about and have relevance in the discussion about robotics that's been prevalent now. But another place that they're innovating behind the scenes is quantum computing. I believe they call it Q2Q, and they have quantum computing simulators that are pretty advanced, and a lot of the researchers are using that. So once quantum computing becomes relevant, they're going to have a giant head start again in that field.
Yes, they've gone wide, where they've basically taken the CUDA playbook and brought that out to a bunch of different verticals. And that should pay out for them over the next few decades.
Yeah. We can't leave page 3 without pointing out that NVIDIA does have a dependence. They are pretty dependent on Taiwan Semiconductor to make the chips. And then Taiwan Semiconductor's pretty dependent on ASML for those machines. And of course, there's some political risk here because Taiwan Semiconductor does all their advanced chip making in Taiwan. They have facilities and spent tens of billions of dollars in Arizona. And I think they made a similar size investment in Japan. But I think one of the problem for anyone who wants to compete with NVIDIA, including Google with their chips, which they build with help from Broadcom, but everyone needs to get some part of TSMC's capacity, which is probably not so easy to do. TSMC reports their sales monthly, and I think each month for the last few months, the sales have been up 30%.
And Samsung's operating profit tripled this quarter. So it shows you that TSMC is maybe even leaving some money on the table by not...
$38 billion. Now, that's mostly from memory. At the same time, you have Elon, SpaceX, xAI, Tesla is bringing Intel into their Terafab project, which they're doing with Samsung. So it's very clear that Taiwan Semiconductor is in a monopoly position, and they have produced less in the size and scale of fabs than what the market is demanding. Now, they're doing that out of conservatism, but also they have the ability to do that because they're the only player.
And then interesting graphic I saw over the weekend of token production by Anthropic, and it's beyond exponential growth since the beginning of this year when AI agents came out.
So is their revenue.
Revenue as well. And I don't think our demand for compute slows down in the foreseeable.
Yeah. The other interesting thing, one graphic I saw, which may have been the same graphic Jason saw, had an estimate of what it was paying for training as compared to, it was surprisingly high, Jason. As I recall, it was like 60% of all the money they pay for data centers for compute, for access to GPUs, was going into training still.
Yeah, it is still a pretty high percentage, but that's changing rapidly. It was, in the 90s, probably a year ago.
Well, Speaking of Anthropic, they just yesterday released a new model which is breaking all the benchmarks, estimating that model cost them $10 billion to train. Nobody has data on this yet, but we believe that it was the first model fully trained on Blackwells. And with that, of course, Elon and xAI have announced the next few models that they're in the process of training, including a trillion parameter model, 1.5 trillion parameter model, a 6 trillion parameter model, and a 10 trillion parameter model. I don't want to estimate the cost of what it's going to take to do all those, but there's a lot coming. And by the end of this year, we're going to have some really interesting models.
Jason, what about healthcare news?
The big thing in the news is the announcement of a 100% tariff. This applies to active pharmaceutical ingredients, and there's a lot of exemptions. So if you're selling a orphan drug or certain cancer therapies, you're exempt. There's off-ramps to avoid the tariffs if you've entered into a most favored nations agreement with the U.S. Also, if you have manufacturing in the States or plan to move manufacturing into the States, then reduce 20% rate. I think 16 now large pharmaceutical companies that have most favored nations agreements with the U.S. Medicare system. But I think because of that, the market reaction was pretty muted on this. And overall, a 100% tariff on the active ingredient is not that big of a deal for a mature pharma company. I don't know if this applies to biotechs in the research stage or if the drug has to be commercially available when the tariff kicks in or not. But really, this is a carrot to onshore the supply chain. So the reason behind all of this, China supplies probably a quarter or more of the active ingredients used in the drugs that we consume in the U.S. And maybe it's more if you trace back through India. It's probably not wise to rely on your adversary to supply the active ingredients for drugs that your citizens are using. So really, this is a project to get companies to onshore or nearshore their supply chains. And China's 11 years into their Project 2025 goal for Made in China. Their initiatives were to do exactly this as well. And that's why we're seeing them become such a big player in the pharmaceutical industry. You know, they're doing this as well. They have a long-term systematic goal of separating dependence on the U.S., probably so that, you know, one day they're preparing for war with Taiwan. So I think this is just another step in that direction.
We promised last week to do some more on Lilly. Lilly's on page 19. It's not that Lilly has the same dominance over its competition that NVIDIA has, but it is the most valuable pharmaceutical company. It has traded as high as $1 trillion for the equity. It's down from there now. If you look at its revenue, year to year was up 40%. Its free cash flow year to year was up 80%. An awful lot of it is weight loss, but Jason can give us a rundown, but there's a lot of other activity going on at Lilly. They seem to just be in an awfully strong position for any large enterprise. I think they've kind of led the march on the most favored nations pricing. Now, the problem, of course, is times earnings or times free cash flow. This is a very expensive stock. I make it at almost 50 times free cash flow. That's more expensive than NVIDIA at 40 times. But Jason, you had to lay out how the next 5 years looks for Lilly. I know you're a little skeptical of patent protection for the weight loss drugs. Where are the weaknesses, if any, of the Lilly position?
I think there's weakness around the competition for weight loss drugs. There's a lot of competitors that are emerging, and they will price aggressively to try to capture any bit of market share and recoup the costs that they have in developing these drugs. Maybe they just sell the assets off to what would traditionally be a generic drug maker. They just try to capture a small margin on it. That said, Lilly's in a great position having a pill form in a small molecule, and they can absolutely compete on the price, and dosing's much easier. So I don't think these drugs are the giant cash cow that they have been, but I don't know. It's hard to compete with Lilly in that market. I don't know if you can essentially cut the pill up and reduce the dosing. We'll see what they do there. I think there is a more valid application for lower doses of this kind of drug, but they haven't pushed for that in the future.
Yeah, I'd say the next couple of years are pretty clear, but I'd say a lot of people and analysts will provide too much confidence in the IP protections around pharmaceutical companies. Anytime there's a really big prize, there's going to be a lot of competition. If you can produce something that's best in class, you can price it wherever you want. And a blockbuster multi-billion-dollar drug can go to zero overnight.
Yeah. I mean, this class of drug was originally for diabetics. Once they discovered it had weight loss characteristics, Lilly and Novo had the head start, but a whole host of startup biotechs were copycats, right behind them. And you have to imagine that there's a whole host of biotechs that are looking at the pill form of this drug once they saw that was possible as well.
To tie this back to the NVIDIA discussion, process power is something that within biotech, we don't see a lot of companies that really have it. I mean, Lilly's moves within the obesity space, but they're going to have a lot of competition, and the barriers to entry are lower than that of semiconductors, at least in my opinion.
We'll take on one of these larger companies next week, but I think for the next few weeks, we'll feature one of these companies. Apple's kind of in the news. Maybe we'll do Apple next week. Another possibility would be Microsoft, with all the concern of how these language models and the applications affect software. Microsoft is down at a fairly low multiple. We'll flip a coin, either do Microsoft or Apple next week, and then we'll do the other one the following week. And with that, we're at least 5 minutes over. Everyone be well and stay healthy. We'll be back exactly 7 days from now. Everyone, thanks so much for listening. Keep well. Bye-bye.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to and no reliance should be placed on the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.